stop looking at the headlines about a diplomatic breakthrough. If you are reading the press release about a new era of cooperation between Washington and Caracus, you are reading the script written for the audience, not the blueprint used by the architects. What happened in the last 48 hours is not a political negotiation. It is a hostile takeover of a physical asset class. The media will tell you that Nicholas Maduro made a deal to save his regime. They will tell you that Donald Trump successfully negotiated a return of Western energy companies to the Orinoco Belt. These are comfortable fictions designed to calm markets and reassure voters. The reality is far colder and far more mechanical. China did not just lose a contract. It did not just lose a shipping route. China lost the specific chemical input required to keep its industrial complex solvent at a moment when its own internal debt cycle is beginning to fracture. This is not a story about oil prices. It is a story about custody of the molecules that power the global supply chain. For the last decade, Beijing operated under the assumption that it had successfully built a parallel energy architecture immune to American leverage. They believed that by purchasing Venezuelan crude in yuan, by using shadow fleets with transponders turned off, and by ensuring cargoes through state-owned entities, they had inoculated themselves against the reach of the U.S. Treasury. They were wrong. What we are witnessing now is the liquidation of that illusion. The United States did not need to send an aircraft carrier to the Caribbean to sever China's supply line. It only needed to seize the financial rails that allow that supply line to exist. This is the difference between kinetic war and thermodynamic war. In kinetic war, you destroy the target. In thermodynamic war, you simply change the temperature of the environment until the target can no longer survive. The deal linking the U.S. and Venezuela is not a handshake, it is a foreclosure. And the entity being foreclosed upon is not the Venezuelan government. It is the Chinese industrial base. To understand why this shift is catastrophic for Beijing, you have to ignore the political rhetoric and look at the chemistry. The global oil market is not a single pool of interchangeable liquid. This is the single greatest misconception among retail investors. They see a price for Brent and a price for WTI and assume that oil is oil. It is not. The modern refining system is a massive chemical balancing act engineered to process specific grades of crude into specific outputs like diesel jet fuel and gasoline. The refineries that power the industrial zones of Guangdong and Shandong were retrofitted over the last 10 years for a very specific diet. They were designed to consume heavy sour crude. This is dense, sulfur-rich petroleum that is difficult to refine but incredibly valuable if you have the right hardware because it yields a higher percentage of diesel and industrial lubricants, the literal blood of a manufacturing economy. Venezuela happens to sit on the largest reserves of this specific heavy sour crude on the planet. For years, Chinese planners treated Venezuela not just as a trading partner, but as a strategic reserve, a guaranteed source of the heavy feedstock that their refineries cannot function without. When Washington sanctioned Venezuela in previous years, it inadvertently forced Caracas to send almost all of that heavy crude to China. Beijing feasted on the discount. They bought billions of dollars of essential energy for pennies on the dollar, effectively subsidizing their own manufacturing dominance with American foreign policy errors. But that flow was never secure. It was dependent on a single variable that Beijing could not control, the physical logistics of the Caribbean. What the Trump administration has just done is weaponize the insurance and liability markets to make the transport of Venezuelan oil to China mathematically impossible. This is the invisible fence. You do not need to blockade a port if you can make the ship uninsurable. You do not need to seize a tanker if you can make the captain personally liable for the cargo. The new agreement between the U.S. and Venezuela essentially creates a closed-loop system. Venezuelan heavy crude is now permitted to flow freely, but only into the United States Gulf Coast. The moment a barrel is designated for a Chinese destination, the new sanctions architecture kicks in not against the country, but against the logistics provider, the ship owner, the reinsurer, the port authority. The message is binary. You can participate in the global financial system, or you can move oil to China. You cannot do both. Faced with this choice, the shadow fleet that Beijing relied on is dissolving. The Greeks are out. The immense network of phantom tankers that kept China fed is heading for the breakers or reflagging for Western routes. The physics of the trade have broken. China is now sitting on billions of dollars of infrastructure designed to process a specific type of oil that it can no longer physically access. This is what I call an inelastic break. In economics, elasticity is the ability to adapt to price changes. But in engineering, when a material is stretched beyond its yield point, it suffers a catastrophic failure. China's energy security has just hit its yield point. The timing of the seizure is surgical. It arrives at the precise moment when the Chinese internal economy is facing a liquidity crisis in its own property sector. Beijing needed cheap energy to offset the deflationary pressure of a collapsing real estate bubble. They needed the arbitrage of discounted Venezuelan oil to keep their industrial margins positive while domestic demand plummeted. By ripping that arbitrage away, the United States has effectively exposed the Chinese manufacturing sector to the full volatility of the global market. They will now have to buy heavy crude from the Middle East or Canada at market rates, competing directly with Western buyers. The discount is gone. The subsidy is gone. And with it, the thin layer of profitability that was keeping thousands of state-owned enterprises alive. This is the hidden mechanic of the deal. It is not about giving American companies access to oil. It is about forcing China to pay a premium for its own survival. It is an inflation export mechanism. Washington is effectively forcing Beijing to import inflation at the exact moment it is trying to fight deflation. It is a pincer movement executed through the bond market and the barrel. But there is a deeper layer here, one that explains why Venezuela flipped. Why would Maduro, a man who has spent years railing against American imperialism, suddenly hand the keys to the empire? The answer lies in the plumbing of sovereign debt. We tend to think of dictators as ideologues, but they are actually fund managers. Their primary job is to manage the cash flow required to buy loyalty. For the last 5 years, China was Venezuela's banker. But China is a difficult creditor. They demand repayment in oil, but they value that oil at a discount. They build infrastructure, but they import their own workers. They provide loans, but the terms are opaque, and the cash often never touches the Venezuelan treasury. It goes directly to Chinese contractors. The relationship was parasitic. Venezuela was effectively a colony of the Chinese state. The United States offered something China could not: liquidity, real hard dollar liquidity. By allowing Venezuela to sell into the U.S. Gulf Coast at market prices, Washington offered Maduro an immediate cash flow injection that Beijing could not match. The U.S. refineries in Texas and Louisiana are desperate for heavy crude. They are built for it. They are arguably the only customers in the world who can pay full price for Venezuelan dirt because they are the most efficient processors of it. The chemistry aligns, the economics align. The only thing standing in the way was politics. And politics is the first thing to dissolve when money is on the table. This is the great irony of the multipolar world thesis. We were told that the BRICS nations were building a new financial order based on mutual aid and shared resistance to the dollar. But when the pressure drops, the alliance fractures along the lines of self-interest. Venezuela did not choose the U.S. because it loves democracy. It chose the U.S. because the U.S. is the only customer that pays in a currency that can actually be used to stabilize a dying economy. You cannot stabilize a currency crisis with yuan that are trapped in a closed capital account. You need dollars. You need the pristine collateral of the U.S. Treasury market. By reopening the Gulf Coast trade, Trump effectively offered Venezuela a lifeline to the dollar system. And in exchange, he took the oil weapon out of China's hand. This is the brutal arithmetic of empire. You do not need to be loved. You only need to be the provider of the reserve asset. The moment Venezuela re-entered the dollar orbit, the geopolitical map of South America was redrawn. China's investments in the Belt and Road Initiative in Venezuela effectively went to zero overnight. The railways that go nowhere, the upgraders that are half-built, they are now stranded assets, sunk costs in a game that has already moved on. We must also look at the technical data coming out of the shipping lanes to verify this shift. Do not listen to the press briefings. Watch the transponders. In the last 3 weeks, the volume of dark fleet tanker traffic heading eastbound from the Caribbean has collapsed. We are seeing a sudden spike in ship-to-ship transfers off the coast of Aruba, but the final destination has changed. These cargoes are no longer heading for Qingdao. They are heading for Corpus Christi. They are heading for Galveston. The flow has reversed. The premiums for heavy sour crude in the Asian spot market have exploded. This is the market screaming that the supply has been cut. Traders in Singapore are scrambling to secure barrels from Saudi Arabia and Iraq, but the Saudis are cutting production to support price. This leaves China in a supply squeeze that no amount of strategic petroleum reserve releases can fix. You can release light sweet crude from a reserve, but you cannot run a heavy coker refinery on light sweet crude efficiently. It is like trying to run a diesel engine on ethanol. It runs hot, it damages the hardware, and it destroys the margin. China is now facing a technical recession in its refining sector. And a refining recession leads to a logistics recession. And a logistics recession leads to an export collapse. This event forces us to reevaluate the entire narrative of the energy transition. We were told that oil was becoming irrelevant, that the future was electric, and that control over fossil fuels was a legacy game. This deal proves that narrative is false. Oil is still the leverage point. It is still the choke point. The United States just demonstrated that it can bring a superpower to its knees, not by banning solar panels or microchips, but by controlling the sludge that comes out of the ground in the Orinoco Belt. It is a return to the fundamentals of power: geography, geology, and gunboats. The U.S. Navy controls the Caribbean. The U.S. Treasury controls the payment rails. The U.S. refineries control the demand sink. It is a tripartite lock that China simply cannot pick. They tried to build a workaround with the Petro-UN and the Shadow Fleet, but workarounds are fragile. They rely on the enforcement gap. When the enforcement gap closes, the workaround collapses. Trump just closed the gap. He told the insurance markets and the shipping oligarchs that the party was over, and because these entities ultimately answer to Western capital markets, they obeyed. They did not obey out of patriotism. They obeyed out of risk management. The risk of being cut off from the dollar clearing system is an infinite risk. The profit from a Chinese oil contract is a finite reward. No risk manager on earth takes that trade. What we are watching is the first battle of the next great conflict. It is not a trade war. It is a war of containment. The goal is to starve the rival of the inputs required to sustain its growth. By seizing Venezuela's oil, the U.S. has removed the energy floor from under the Chinese economy. Now Beijing must burn its foreign reserves to buy expensive energy. Every dollar they spend on oil is a dollar they cannot spend on semiconductor research, or military modernization, or belt and road expansion. It is a resource drain strategy. It forces the adversary to burn their seed corn just to keep the lights on. And the most terrifying part is that there is no obvious countermove. China cannot force Venezuela to sell to them. They cannot militarily challenge the U.S. in the Caribbean. They can only pay more. And paying more is exactly what the U.S. wants them to do. It bleeds them dry. It accelerates the liquidity crisis. It turns the screws on a system that is already cracking. This is the state of play. The headlines will call it a deal. But you know better. It is a siege, and the walls just moved closer. The question now is not what China will do to get the oil back. The question is, what will break first inside the Chinese system now that the energy subsidy is gone? Will it be the currency? Will it be the banks? Or will it be the social contract itself? Because an empire that cannot provide cheap energy and stable growth is an empire that is running on borrowed time. And the lender of last resort just called in the loan. You have to understand the scale of the trap that just snapped shut. For the last 5 years, Beijing played a very specific game with its energy reserves. They were not just buying oil, they were engaging in a massive carry trade. They borrowed cheap dollars in Hong Kong, converted them into infrastructure projects in Venezuela, and expected to be paid back in cheap oil for the next 30 years. It was a perfect loop. Debt out, energy in. But that loop relied on one critical assumption, that the asset, the oil, remained under their effective control. By flipping the allegiance of the logistics providers, the United States didn't just cut the supply, they effectively defaulted on China's investment without ever signing a contract. All those billions poured into the Orinoco Belt, the upgrading facilities, the port expansions, the pipelines. That capital is now dead. It is stranded equity. China paid for the cow, but the United States is now milking it. This is wealth transfer at the sovereign level. It is not theft, it is rehypothecation. The U.S. effectively rehypothecated the entire Venezuelan energy sector onto its own balance sheet, leaving Beijing holding the receipts for infrastructure it can no longer use. This brings us to the most dangerous mechanism in this entire sequence, the refining spread. To the average person, a refinery is just a factory. To a financial analyst, a refinery is a bond. It has a yield. You put crude in, you get product out, and the difference is your coupon payment. The Chinese refining sector, the largest in the world by capacity, was built on the assumption of a sovereign discount. They assumed they would always have access to sanctioned oil at $20 or $30 below the global spot price. That discount was their margin. It was the only thing keeping their petrochemical industries competitive against the US and the Middle East. With this deal, the discount has evaporated. Donald Trump didn't just redirect the oil, he repriced it. Venezuela is now selling to the Gulf Coast at market rates, minus a small transport fee. The global price of heavy crude has converged. What does this mean for China? It means their refining margin just went negative. Thousands of independent teapot refineries in Shandong province are now mathematically insolvent. They cannot afford to buy crude at $75 and sell diesel at a price the slowing Chinese economy can absorb. We are looking at a wave of industrial bankruptcies that will ripple through the Chinese banking system within the quarter. And this is where the plumbing gets truly terrifying. Most people do not realize that these Chinese refineries are not just energy companies, they are financial vehicles. They are heavily leveraged. They use their oil inventories as collateral to borrow cash from the shadow banking sector. It is called commodity financing. You buy a tanker of oil, you park it in a storage tank, and you use the receipt to get a loan to speculate on real estate or stocks. It is a massive, hidden leverage pile sitting on top of the energy market. By cutting the flow of Venezuelan oil, the U.S. has destroyed the collateral backing these loans. The tanks are emptying. The receipts are worthless. The shadow banks are making margin calls that the refiners cannot meet. This is how a shipping dispute in the Caribbean triggers a liquidity freeze in Shanghai. It is the butterfly effect, but the butterfly is an oil tanker and the hurricane is a credit contraction. We are watching the unwinding of a $1 trillion commodity financing trade that most Western analysts don't even know exists. Now, look at the currency layer. Why did the petro-yuan fail to stop this? We were told that the yuan was the future of energy settlement. We were told that Venezuela, China, and Russia were building a fortress balance sheet. But when the crisis hit, what did Caracus ask for? Did they ask for more renminbi? No. They asked for permission to access the SWIFT system. They asked for dollars. This is the reality check that the de-dollarization crowd refuses to acknowledge. You can trade in yuan when things are calm. You can trade in gold when you are hoarding. But when you are starving, when your infrastructure is crumbling and your population is restless, you need the currency that buys everything. You need the dollar. The dollar is not just a currency, it is a technology. It is a logistics network. By granting Venezuela a license to sell to the US, Washington effectively turned the dollar spigot back on for Maduro, and he drank it up because he had no choice. China could offer credit, but they could not offer liquidity. There is a difference. Credit is a promise, liquidity is a fact. Venezuela needed facts. This reveals the fundamental weakness of China's Belt and Road diplomacy. It is asset heavy, but liquidity poor. They build bridges, ports, and railways, hard assets that are stuck in the ground. The United States projects power through soft rails: law, insurance, banking, and currency. Soft rails are flexible. You can switch them off with a signature. Hard assets are liabilities if you cannot defend them. China is now realizing that it has spent $1 trillion building a global empire of physical infrastructure that it cannot legally defend against American administrative power. They built the chessboard, but the US controls the rules of the game. Trump's move was a demonstration of administrative supremacy. He used the Office of Foreign Assets Control, OFAC, not as a blunt instrument, but as a scalpel. He carved China out of the transaction without sanctioning China directly. He simply made it illegal for the logistics chain to service them. It is lawfare at the highest level. And what happens to the global energy market now? We are about to see a bifurcation, a split. For the last 20 years, we have had one global oil market. Price discovery was universal. Now, we are moving toward two distinct pricing zones. The US zone, North America, South America, and Europe, will have access to abundant, secure, and relatively stable energy flows. The Asian zone, specifically China, will be forced to rely on the Middle East and Russia, both of whom will now charge a premium because they know Beijing has nowhere else to go. This is the insecurity premium. China will pay more for every barrel than its competitors in the West. Think about the implications for manufacturing. If electricity and diesel cost 20% more in Guangdong than they do in Texas, the manufacturing advantage shifts. The reshoring narrative is no longer just about patriotism, it is about thermodynamics. Energy seeks the path of least resistance. Manufacturing seeks the path of lowest energy cost. By recapturing Venezuelan supply, the US has lowered its own energy cost basis while raising its rivals. It is a double-digit swing in industrial competitiveness overnight. Do not underestimate the psychological blow this deals to the Global South alliance. Brazil is watching. Saudi Arabia is watching. They see that when push comes to shove, the United States can still dictate the flow of the world's most strategic commodity. The narrative of American decline was premature. The empire was not dead, it was just sleeping. And it woke up hungry. The deal is a signal to every other nation in the OPEC cartel. The door to the US market is open, but only if you play by the rules of the dollar architecture. If you try to build a parallel system, you'll be cut off. Venezuela tried. They suffered for a decade. Now they have capitulated. It is a cautionary tale written in crude oil. So where does the pressure go next? It goes to the Straits of Malacca. It goes to the South China Sea. Because if China cannot secure its energy through economic diplomacy, it will eventually feel forced to secure it through kinetic presence. The loss of the Venezuelan supply line makes the remaining supply lines, from the Persian Gulf and Africa, existentially vital. Beijing cannot afford to lose another one. This makes them more desperate, more paranoid, and more dangerous. We are moving from a period of economic competition to a period of resource anxiety. And anxious empires make mistakes. They overreach. The US has successfully backed China into a corner, but a cornered actor is volatile. The oil war is not over. The front has just moved. The Caribbean is secured. The Pacific is next. We need to talk about the silence. The most terrifying sound in a financial crisis is not the shouting on the trading floor. It is the silence in the interbank lending market. Right now, if you put your ear to the ground in Shanghai, you can hear the liquidity evaporating. The cutoff of Venezuelan heavy crude is not just an industrial problem. It is a collateral shock. You have to understand how the shadow banking system in China actually works. It does not run on trust. It runs on receipts. For the last decade, commodities, specifically stockpiles of copper, aluminum, and oil, have been used as the foundational collateral for trillions of yuan in off-balance sheet lending. A private refinery imports a tanker of Venezuelan crude. They put it in a bonded warehouse. They get a warehouse receipt. They take that receipt to a shadow bank and pledge it for a short-term loan. They use that loan to pay their workers, service their debt, and speculate in the property market. It is a collateral chain. And the critical link in that chain is the valuation of the oil. When the U.S. seized the logistics, they didn't just stop the flow of new oil, they destroyed the valuation of the existing stockpile. If you are a shadow banker holding a receipt for Venezuelan crude as collateral, and suddenly the crude cannot be easily replaced or priced transparently because the supply line has been severed, what do? You mark it down. You increase the haircut. You demand more collateral. This is a margin call on the entire Chinese industrial sector. We are seeing reports of repo failures in the Chinese interbank market. This is the ghost data that Western media ignores. The repo rate, the cost to borrow cash overnight against collateral, is spiking in the provinces. Why? Because the collateral is suspect. The banks are looking at these receipts for sanctioned oil and saying, I don't know what this is worth anymore. I don't know if you can get more of it. I'm not lending against it. The credit window is slamming shut. This brings us to the Shandong teapots. These are the independent refineries that make up a huge chunk of China's processing capacity. They are the swing producers of the global market. They are nimble, aggressive, and dangerously leveraged. They were the primary buyers of that discounted Venezuelan sludge. Without it, their business model is mathematically impossible. They are configured for high sulfur inputs. To switch to sweet crude from West Africa or the U.S. Permian Basin requires different cracking units, different catalysts, and most importantly, higher prices. They cannot afford the premium. So, what happens? They shut down. We are already seeing maintenance schedules being extended indefinitely. Maintenance is the industry euphemism for bankruptcy. When a refinery stops running, it doesn't just stop making diesel, it stops generating cash flow to service its debts. And because these refineries are the economic engines of entire cities in eastern China, when they stop, the local tax revenue stops. The local government debt vehicles, the LGFVs, start to wobble. It is a contagion that moves from the port to the bank to the city hall. And do not believe the narrative that China can simply dip into its Strategic Petroleum Reserve, SPR, to weather the storm. The SPR is a national security asset, not a commercial buffer. It is there for war, not for price arbitrage. Furthermore, the composition of the SPR is a state secret, but intelligence suggests it is heavily weighted toward medium sour grades from the Middle East, not the super heavy Venezuelan tar required for the specialized asphalt and industrial lubricant market. You cannot pave roads with light, sweet crude. You cannot run heavy marine engines on gasoline. There is a molecule mismatch. The strategic reserve is a blunt instrument. The market needs a scalpel. China is missing the scalpel. Now, zoom out to the currency war. This energy shock is hitting the renminbi at its weakest moment. China is currently fighting a massive capital flight problem. Wealthy citizens are trying to get their money out. The central bank is burning foreign exchange reserves to keep the yuan stable against the dollar. Now, suddenly, they have to spend more dollars to buy energy because the cheap Venezuelan option is gone. This is the balance of payments trap. Every extra dollar spent on Saudi or Iraqi oil is a dollar that cannot be used to defend the currency peg. It accelerates the burn rate of China's forex reserves. Washington knows this. The strategists at the U.S. Treasury understand that if you force China to buy energy at market rates, you drain their war chest faster. It is a war of attrition. You force the adversary to bleed cash just to maintain the status quo. There's a historical echo here that is impossible to ignore. Look at Japan in 1941. The United States imposed an oil embargo that forced the Imperial Navy to make a choice: collapse slowly or attack quickly. I'm not saying we are on the brink of Pearl Harbor, but I am saying that the physics are similar. When you cut off a rising power's access to affordable energy, you force them into a decision dilemma. Do they accept the economic contraction and the social unrest that comes with it, or do they lash out to secure new resources? China is now in the containment box. They are surrounded by U.S. bases, their tech imports are restricted, and now their cheap energy tap has been turned off. The pressure inside the system is rising. And unlike a democracy, which can vent pressure through elections, an authoritarian system has no release valve. It has to suppress the pressure until the tank explodes. The deal between the U.S. and Venezuela is effectively an encirclement maneuver. It closes the back door that China had left open in Latin America. For years, Beijing thought Latin America was its strategic backyard, a place to park capital and extract resources far from the reach of the U.S. Navy. That theory has been disproven. The U.S. just reminded the world that the Monroe Doctrine is not dead. It was just digitized. The ability to control the financial and insurance architecture of the Western Hemisphere is effectively absolute. China is being pushed back across the Pacific. The Belt and Road is retreating. The Maritime Silk Road is being blockaded, not by ships, but by sanctions and waivers. This leaves Russia. Everyone asks, won't Putin help? This is the trap of thinking in alliances instead of interests. Russia loves this. Why? Because Russia sells a competing grade of oil, Urals. If China loses access to Venezuelan heavy, they become more desperate for Russian barrels. Putin gains leverage. He can charge a higher premium. He can demand better terms. The no limits partnership between Moscow and Beijing is a partnership of convenience, and there's nothing convenient about a desperate partner. Russia will squeeze China just as hard as the US does, simply because they can. In the commodity markets, there are no friends. There are only buyers, sellers, and victims. China just became the victim. So we have to ask the uncomfortable question. If the shadow fleet is gone, and the Russian option is a trap, what is the actual exit strategy for Beijing? The answer is, there isn't one. This is what financial analysts call a terminal rate problem. When the cost of capital, or in this case, the cost of energy, rises above the rate of return on your manufacturing base, you stop growing. You start liquidating. China is now entering a phase of industrial liquidation. We are already seeing the signs that crack spreads, the profit margin for refining crude oil into diesel, in Asia have collapsed to multi-year lows. This is not a market fluctuation. This is a structural signal that the input costs are too high and the demand is too weak. The system is seizing up. And here is where the ghost data becomes critical. Look at the inventory draws in Singapore. Singapore is the fueling station of Asia. For the last 20 years, Chinese demand has kept those tanks full. In the last month, we have seen a rapid drawdown in fuel oil stocks. Why? Because China is quietly exporting its remaining product to raise cash. They are selling the furniture to pay the rent. This is a desperate move. When a manufacturing superpower starts liquidating its energy inventory, it is signaling that it expects a contraction. It is preparing for a hard landing. The Western media is still talking about 5% GDP growth targets. Stop listening to the targets. Look at the tanks. Empty tanks do not lie. This brings us to the dollar weaponization narrative. We often hear that weaponizing the dollar will drive the world away from it. That is the popular theory. But look at what just happened with Venezuela. The US weaponized the dollar against Caracus for a decade. Did Venezuela abandon the dollar? No. The moment they got a chance, they came running back to it. Why? Because the dollar is not just a currency you hold, it is a network you use. It is the operating system of global commerce. You can hate Microsoft Windows, but if every computer in the world runs on it, you have to use it to send an email. The US just proved that the network effect of the dollar is stronger than the political will of the BRICS. Venezuela tried to leave. They failed. Now they are back in the fold, selling their oil for dollars, settling their debts in dollars, and stabilizing their economy with dollars. This is a devastating psychological blow to the anti-dollar coalition. It proves that when the chips are down, the king dollar is still the only game in town. And let's be clear about what this means for the average person watching this. You might think, I don't live in China, why do I care? You care because China exports deflation to the world. For 30 years, cheap Chinese labor and cheap Chinese energy subsidies gave you cheap iPhones, cheap TVs, and cheap furniture. That era is ending. If China's energy costs go up, your cost of living goes up. The China price is about to be reset. We are moving from a world of abundance to a world of scarcity. Inflation is not transient. It is structural. And it is being driven by the repricing of the global energy map. When the factory of the world has to pay a premium for power, the customer pays the bill. The customer is you. But there is an opportunity here for the prepared. While China is being squeezed, look at who is benefiting. The U.S. Gulf Coast is booming. The refineries in Texas are about to enter a golden age of margins. They are getting cheap, heavy crude from Venezuela and selling high-value diesel to a starving global market. The spread is massive. The energy dominance of North America is being solidified. We are seeing a capital rotation out of emerging markets and back into the U.S. energy sector. The smart money is not chasing the next China. It is doubling down on the new America. An America that is energy independent, chemically self-sufficient, and ruthless in its use of economic statecraft. The tragedy of this situation is that it was entirely avoidable for Beijing. They had the capital, they had the time. But they bet on the wrong horse. They bet that political alliances could overcome economic gravity. They thought that a handshake with Maduro was worth more than a contract with Exxon. They forgot the golden rule of the oil market. He who controls the insurance controls the shipping. He who controls the shipping controls the supply. The U.S. never lost control of the insurance market. Lloyd's of London, the P&I clubs in New York and Scandinavia, They all follow OFAC rules. The moment the US decided to enforce the rules, the game was over. China was playing checkers on a board designed for three-dimensional chess. So, as we move into the final phase of this analysis, you need to strip away the noise. Forget the speeches at the UN. Forget the press releases about win-win cooperation. Look at the flows. The oil is flowing north, not east. The money is flowing into US treasuries, not Chinese bonds. The leverage has shifted. The United States has successfully executed a margin call on the geopolitical ambitions of its greatest rival, and the bill is due now. This brings us to the internal mechanics of the collapse, the part that Western analysts are too polite to discuss. When a sovereign power loses its energy subsidy, it does not simply accept poverty. It engages in cannibalization. The Chinese Communist Party has operated for 30 years on a very simple implicit contract with its population. We deny you political freedom, and in exchange, we guarantee you economic upward mobility. That contract was funded by the arbitrage of cheap labor and cheap inputs. The labor is no longer cheap. Demographics took care of that. And now, thanks to this deal, the inputs are no longer cheap. The contract is void. So how does the state survive when it can no longer deliver growth? It turns inward. We are about to see a massive acceleration of financial repression. This is a technical term for when a government deliberately channels funds from private savers to the state sector at below market rates to keep the system solvent. In plain English, they're going to loot the household balance sheets to bail out the strategic industries. The wealth management products, WMPs, that millions of Chinese citizens used as savings vehicles, they are heavily exposed to the very industrial sectors that are now being starved of energy. When those sectors default, the state will step in, but not to save the saver. They will ring-fence the losses and force the population to eat the haircut. This is the internal bail-in. Watch the capital controls. They are the pressure gauge. In the last 48 hours, we have seen informal guidance issued to banks in Guangdong to restrict the purchase of foreign currency for non-essential imports. What is a non-essential import? It is anything that isn't food or fuel. This is the beginning of the internal blockade. The state is effectively rationing the world. They are hoarding dollars to pay for the expensive Saudi oil they now need to replace the cheap Venezuelan crude. The average citizen's ability to interact with the global economy is being sacrificed to keep the lights on in the state-owned steel mills. It is a transfer of wealth from the consumer to the party's survival mechanism. And this creates a terrifying feedback loop for the global economy. If the Chinese consumer is being squeezed to pay for energy, they are not buying German cars. They are not buying French luxury goods. They are not buying American soybeans. The China reopening trade that Wall Street has been trying to sell you is dead. You cannot have a consumption boom in an economy that is undergoing an energy shock. It is mathematically impossible. The discretionary income is being vaporized at the gas pump and the utility meter. The deflation we talked about earlier, it will get worse for manufactured goods because domestic demand will collapse, forcing factories to dump products on the global market at any price just to generate cash flow. But for commodities, for the things you actually need to survive, prices will rise. It is the worst of both worlds. Deflation in what you own, inflation in what you eat. We also need to look at the neighbor risk. Vietnam, India, and Mexico are watching this dismantling of the Chinese energy chain with intense interest. But why? Because capital hates a vacuum. As Chinese manufacturing becomes more expensive and less reliable due to these energy constraints, the factory Asia model doesn't die, it migrates. We are seeing a kinetic shift of capital expenditure, CapEx, moving to places with secure energy. Vietnam has offshore oil. Mexico has a direct pipeline to Texas natural gas. India has a sweet deal with Russia. The comparative advantage is shifting violently. This deal between the US and Venezuela essentially tells every global CEO, if you build your factory in China, you are building it at the end of a vulnerable supply line. If you build it in Mexico, you are building it inside the fortress. The risk premium for investing in China just doubled. Let's go deeper into the plumbing of the banking sector. The Big Four. Chinese state banks are effectively arms of the Treasury. They are not commercial entities. They are policy tools. For years, they have been rolling over bad loans to the heavy industrial sector, the zombie companies. These zombies relied on the cheap Venezuelan crude to maintain a semblance of solvency. With that input gone, the zombies are now bleeding cash. The Big Four banks now face a choice. Do they let the zombies die and trigger mass unemployment? Or do they print more yuan to keep them alive, risking hyperinflation? History tells us they will print. They always print. This means the value of the yuan is going to be diluted to pay for this energy shock. If you are holding Chinese bonds, you are holding a claim on a currency that is being debased to fight a resource war. The yield you see on the screen is a mirage. The real yield, adjusted for the coming devaluation, is negative. This is the entropy of the system. In thermodynamics, entropy is the measure of disorder. The Chinese system was low entropy because it was highly ordered and subsidized. The US just injected a massive dose of chaos into that system. By removing the stable energy input, they have increased the entropy of the Chinese economy. Disorder is expensive. It requires more energy, more money, and more force to control. We will see this manifest in social control measures. The surveillance state isn't just about political power, it is about economic triage. You need to monitor the population closely when you are about to lower their standard of living by 20%. And where is the US in this entropy equation? The US is becoming the low entropy zone. By securing heavy crude from Venezuela, light sweet from the Permian, and cheap gas from the Marcellus, the North American industrial base is becoming the most ordered and stable thermodynamic system on the planet. Capital flows from high entropy to low entropy. It flows from chaos to order. This is why the dollar is rallying. It is not just interest rates, it is physics. The world is realizing that the US is the only major economy that is not currently facing an existential energy crisis. Europe is de-industrializing. China is suffocating. The US is just getting started. This is the endgame. We are no longer dealing with a negotiation. We are dealing with a liquidation event. The deal was the gavel coming down. Now the assets are being auctioned off, and you need to understand who the buyers are. While the media focuses on the geopolitical tension, Wall Street is already executing the Great Rotation. Capital is leaving the emerging markets index funds at a pace we haven't seen since 1998. It is flooding into North American industrial capacity. This is not speculation. It is a flight to safety. But safety in 2026 doesn't mean a bank account. It means a jurisdiction where the lights stay on and the contracts are enforced. It means the United States. You have to strip away your political biases. You might hate the Fed. You might hate the deficit. You might think the debt is unsustainable. The market does not care about your feelings. The market cares about relative survival. And relative to a China that has just lost its primary energy subsidy, the United States looks like a fortress. The US is essentially reindustrializing by cannibalizing the energy security of its rivals. It is a ruthless, predatory strategy, and it is working. The Rust Belt is about to become the energy belt. The refineries in the Gulf are the new central banks. They print the diesel that powers the world. If you control the diesel, you control the GDP. So, what is the trade? Stop chasing the catch-up growth in Asia. That story is over. The next China is not India. The next China is Texas. The next China is the reshored supply chain that runs from Mexico City to Montreal. This is the Fortress North America thesis. Position yourself in the assets that benefit from this energy disconnect. Look at the midstream pipeline companies that move this heavy crude. Look at the complex refiners that can process it. Look at the defense contractors that secure the sea lanes that allow this trade to happen. These are the new blue chips. They are not tech stocks. They are kinetic stocks. They profit from the friction of the real world. And watch the ghost data one last time. Watch the spread between the Shanghai energy price and the Houston energy price. As that spread widens, the profit margin of every company in America widens relative to its competitor in Asia. It is a mathematical inevitability. The China price is rising. The America price is stabilizing. This creates an arbitrage opportunity for the next decade. We are witnessing the greatest reallocation of capital in a century. The globalist era of flat, frictionless trade is dead. The mercantilist era of walled gardens and resource monopolies has begun. Do not be sentimental about the old world. It is gone. The system is resetting, and it is resetting in favor of the incumbent power. The United States just proved it has the ability to turn off the tap. China just proved it has no plumbing of its own. The lesson is brutal but simple. In a financial war, never bet against the guy who owns the currency, the navy, and the oil. History rhymes, because systems reward the same mistakes. The mistake was believing that money could exist without power. It cannot. Power is the collateral that backs the money. And the United States just posted the collateral. Position yourself accordingly.